Okay, good morning, everyone. Welcome to the Do More With Your Money True Potential podcast, episode 46 on Friday, the 4th of December. I'm Mark Henderson, Senior Partner in True Potential and Head of True Potential Investments. And I'm joined this morning by three of my colleagues from the investment management firm. First of all, we have Jeff Casson, Chief Investment Officer. We have Chris Leyland, Director of Investment Strategy, who has gone off to London to live for a few months. And further up the Tyne Valley from me, we have George Bell, one of our fund analysts. Good morning, gentlemen.
Morning, Mark.
Morning, Mark.
We've got some snow in the northeast today, and I guess it'll be the same with you, Jeff, up in Jedburgh.
Yes, a lovely white start to the morning. I was quite surprised when I got up to see that on the ground, but yeah, it does make it a bit more festive feel to the morning.
Yeah, George, have you looked out of the window yet?
Yeah, I tried to go for a run, but I ended up doing some star jumps in the garage instead, Mark. It reminds you how quickly we're plowing through 2020, but it was quite nice to see.
Good start your morning. And Chris, what about you in Tier 2 London?
In Tier 2 London, sadly, it's not snowing today. It's actually raining. So when I was in the park this morning, it was very cold, very rainy, but sadly no snow at all.
Chris, I think you need to explain why you were in the park this morning before we get any further.
I thought you might ask that.
Question of the day.
Question of the day, yeah. No, I've been trying to get a little bit fitter. So basically, I've hired a personal trainer, and therefore 3 times a week at 6 o'clock in the morning, I go to Kennington Park and do various bits of running and press-ups and star jumps and stuff like that, and probably get laughed at people that are walking past me.
And Chris, your local pub, the Doghouse, will you be there this weekend?
Hopefully I won't be in the Doghouse this weekend, no. But most weekends I do tend to find myself there. But I think I will venture out tomorrow afternoon. I'm curious to see what this sort of substantial meal thing, how that works overall. And I'll be honest, I quite fancy a nice ice cold pint of lager as well.
I think a substantial meal could be relative, Chris, but we might come on to that a little bit later.
Yeah, some of my mates were making some jokes about a substantial meal for me, but
what I want to look at today is a review of November, and I'm going to bring you all in at different points. But I think what we've seen is signs of consumer confidence returning. Look at the high street, look at the queues outside the shops as they reopened during the week. We've got other signs as well. We've seen Ryanair order 75 new aircraft, which brings the order up to 22 billion. And at True Potential, we've had our best month ever for new business coming into us, with over $500 million coming in. And to new clients who may be watching this podcast for the first time, welcome, and I hope you enjoy the next hour. Jeff, if I can turn to you. November has been eventful. It started with 1 or 2 notable events, and they've continued all the way through the month. Would you bring us up to date, please, with exactly what's happened during the month? Yep,
certainly. I'll do my very best to do that. There's just so much so you might have to jump in and stop me at points in time. So a month that really continued to build on what has been surprises through 2020 at certain time, and the month where we had a presidential election in the US. We had 3 vaccines on 3 consecutive Mondays of the month, which, going back to the first one of those on the 9th of November, was really coming probably ahead of expectations in terms of the timing of getting a vaccine into production and providing some details on the efficacy. So speaking to our managers, I think most of them were thinking we would get updated around the very end of the year or into the first quarter of next year. Pfizer came out on the 9th. The following week we had Moderna. The week after that we had AstraZeneca with the Oxford University study. And I suppose each of them suggesting really strong success rates and efficacy, as they term it, for their vaccines, which is great for for society in general, in the sense that we can look to get these rolled out, get the doses out and used over the coming 12, 18 months, allowing economies to start to heal and heal further from where they are today, but most importantly, get confidence improved, confidence in businesses and their willingness to spend, consumers and their willingness to consume, which is really crucially important given where service industries have got themselves to at this point in time. We really need the service industry to come back, particularly in Europe and the UK. And as you allude to there, Mark, you can see there is pent-up demand. When restrictions ease, people want to consume, a bit like you've just said there, Chris, as well. In tier 2, you want to go out, you want to see what things are like, you want to get, you want to consume, you want to get back to the way we did things before. Just maybe to put a little bit of sort of meat around those positive announcements, what did that really then mean for asset markets in general? And just looking at asset market performance, struggling actually to find anything that was really negative over the course of the month. And I think it's surprising, particularly as it relates to sort of sovereign bonds. But if we look at what's been going on in equity markets in general, we had MSCI World up about 13% in local terms, 9% in sterling terms over the course of the month. Looking at individual indices, we had European, the stock 600 up about 13% over the course of the month. FTSE something similar. We look in the US, the major indices there up 10 and 11%. All moves that are, rolling off the tongue, but they're abnormal. You don't typically see that type of move in a month. But again, great for end clients. If we think about looking at economic recovery, small cap, a really area that's keyed into that. The Russell 2000 in the US was up about 18% over the course of the month. So nearly, exceptionally strong returns across the piece. Then even turning that to broader and thinking about bond markets and sovereign bond markets, about 2% across sovereign bond markets across the index at a high level there. High yield and investment grade, we saw really strong returns coming through there. And the EMD as well, so emerging market debt, where we got the double benefit of a positive return from the asset class, but then a benefit from the dollar continuing to weaken. And that's been a trend that we've been discussing on our morning markets videos for the past number of months. The weakness that we've been seeing coming through in the dollar has been really a boost for emerging markets. But I just wanted to take a little bit of time to dig into that, because as an industry, we've got a real want to look at things at the headline level. And I think this month itself, it's really masking some fascinating underlying trends and underlying returns that have been earned. So if we look at it at a sector level, what are some of those sectors and industries that have been really strong over the month? Well, it's been financials. Looking at the broad financials index, it's returned close to 20% over the month. Energy, closer to 30%. Industrials, 15%. What do those all have in common? They're tied to an improving economic environment. And those that are economically sensitive or cyclical, as you might hear some of us refer to it, they have done exceptionally well over the course of the month. But then it's important to remember where they're coming from. They're coming from a really weak starting point. They've been some of the poorest performing areas. And that's what I mean. We saw a big rotation in markets over the course of November. And that rotation to those economically sensitive areas, but also to those which we might call value. And value as a style doing very well over the course of the month. But it wasn't just at the expense of growth. So if we look at growth over the month, growth did well. It was up 10%. That would have been a great return for anybody in any sector itself. So it's been a broad-based recovery, but subtle rotations within the markets to those more cyclical areas. And then just I think two other comments to make. One, around sterling itself. It's been a very good month for sterling. Sterling up over 3%. We'll maybe come on and talk about some of the factors that have been driving that. And then just looking at, well, there has to be something that was slightly negative or slightly weaker over the month. But actually, it's only two commodities that I can see on the page that I look at, being gold and silver. and they are your real defensive go-to assets that people have rotated away as they've seen further opportunity to earn return elsewhere. So just in commodities, we look at what copper's telling us. Many market people think about copper and they call it Dr. Copper, because it gives you an indication of industrial demand and industrial activity, and that's been really strong. If we look at iron ore, something similar, oil up over 20% over the course of the month. Phenomenal moves within markets and within asset classes, and really positive for end clients and those that have been invested through that period in terms of the strong returns that it's delivered. I'll maybe stop there before I get even more excited and let some others jump in.
Yeah, it's a marked difference to what we were seeing in March of this year, and it's been a nice month to be investing money. And Chris, Jeff's given us what's happened in the markets. How has that been seen in the portfolios, please?
Yeah, sure. So as you can imagine, it's been a pretty phenomenal month for the True Potential portfolio proposition as well. So if we look at the balanced portfolio, that's up just shy of 7%. If we look at the aggressive portfolio, that's up around about 10%. So very strong returns from virtually every single asset class, as Jeff's just said. And I'm really pleased to say that's come through into the True Potential portfolio proposition. So if we think about, I guess, the underlying components of the proposition, and that would be the individual managers. So who's really contributed to that? So firstly, UBS. Jeff, you mentioned something which is cyclicality. So basically assets that are more economically sensitive, so more sensitive to that economic recovery. And what you've seen is UBS have a very good positioning around that. And that's been really beneficial for the UBS proposition overall. And also for Goldman Sachs as well, so through their Income Builder Fund. So Jeff, you mentioned around currency and the fact that sterling had done well. We'd also seen US dollar weakness. So if you look at sterling US dollar, sterling has appreciated by around about 3% compared to the US dollar over the month. And that Goldman fund, it doesn't have any non-sterling currency. So relatively, that's been a big benefit for Goldman. But as well as that, they also have an income style as well. And one thing that I think has actually been quite nice over the last couple of months, not necessarily just for November, but what you're starting to see is companies going back to normal. And what do I mean by that? I mean, basically companies restarting paying their dividends. That could be, things like the banking sector where they're in negotiations with the regulator to try and restart paying dividends, in the sense they've got very, very strong balance sheets right now. And it really is only the regulator that's stopping them from paying dividends. Or it could just be companies, where they paused paying dividends in March. Maybe they thought it was more prudent to hold some of that cash. But actually, because the economic environment is improving, because we've now got that vaccine, because we now have a way through COVID overall, you're starting to see a return to normality. And I think just the final thing for me, Jeff alluded to the kind of probably the big rotation that you'd seen in November and the disparity in sector performance and style performance. And I think with the True Potential portfolios, one of the key things that we always believe in is diversification. And we always believe that, fund managers, they don't outperform all the time. And that's exactly what you've seen this year. If I think of maybe someone, say, like Close Brothers, August time, they were performing phenomenally well. But actually November, they were relatively not as good compared to some of the other managers. And that's what you've seen. You've seen a rotation in style. The portfolios to take advantage of that.
It's evident as well. The portfolios have got over 5 years track record now, and the balanced portfolios up, say, 40% over that period of time, and the aggressive is nearly up by 60%. So, and we've seen some shocks in the market throughout those 5 years, but those figures have still come in. George, you've been sitting patiently there, and I kind of talked over you a little bit, so apologies for that. But Chris was talking the funds that are within the portfolios, and he mentioned UBS and Goldman Sachs, who are just two of our managers who are running exclusive True Potential funds that make up the portfolios. I know that in this last week you've been involved in a lot of the meetings with the managers, the virtual meetings that we hold. Have you seen any key themes coming out of those meetings that you'd like to bring out now, George?
Yeah, absolutely. I think the only additional point I would add to UBS is their agility environment, which we've been adding to throughout the month of November, which clients will have seen within their portfolios. And, that's a great endorsement for why we do what we do at True Potential in the research process. So that's part of the process we've been through this week, speaking with all of our fund managers. Some of the key themes we've mentioned there, the rotation which we've seen coming through from, say, the large cap growth stocks companies in there, so the big tech names into the smaller mid cap names. We've seen that in taking areas such as the UK, an area which has been underloved, it's been underowned in this environment. It's taken a little bit longer to recover than most developed markets. It's typically the UK market is made up of a basket of financials, energy names, industrials, which have had a tough 2020. But managers are starting to see good opportunity within the smaller market capitalization names there. So we've seen some activity within our managers to access that. I think within the US, there's been a theme of looking to reduce some of the concentration to those big tech names to broaden that out to really access the theme which we've seen coming through. I'm not talking about a wholesale shift. As Jeff mentioned, growth is still done well for portfolios. We still give access to that, and it's done the portfolios very well. But these are tactical adjustments which are implemented by our managers to really exploit that broadening out and pick up the opportunities there. I think within global bonds, Jeff mentioned the yield levels which we've seen, not only on a sovereign side, but on a corporate side as well. Global company bonds, we saw a big spike out in yields, and we've seen yields come back in. We're almost at the level now we were pre-pandemic. So a lot of the good gains have been made. So what does that mean? Well, it means it's really an opportunity for active managers to step in there. So what's been good about the research work which we've been doing is identifying some of the positions which our managers have been making to look outside of the non-traditional bond asset classes, looking at whether it's a relative opportunity and their ability to play that, or look into areas such as Chinese bonds direct and their ability to actually access these on a very flexible basis. So what we're saying there is it's been a fantastic November for the True Potential portfolios, but we're not going to stop and give ourselves praise just yet. Markets roll on. And what we're saying here is our active managers on a day-to-day basis to really exploit a number of these opportunities which are coming through. Jeff mentioned precious metals there. Another example within precious metals was silver, traditionally more linked to the industrial sectors. It's got great industrial properties. It's used in solar panels and in a number of areas. I think we saw some potential eyes looking towards that precious metal as we look forward. So there's a couple from me. Chris, I don't know if you want to jump in and add some greater detail.
Yeah, sure. I think, George, you've covered quite a bit there, but I think probably a couple of things that I found quite interesting. I quite like sort of pinning fund managers down around their views. And one thing that we did is we asked them to score how much faith they have in a cyclical recovery over the next 12 months, so between 1 to 10. And I think the average was around about 7.5. So it does give you that feel of the confidence that the managers have overall in where we are moving to over the next 12 months. The lowest score was 7. The highest score was 9. Unfortunately, we didn't have any 10s, but I don't think you'd see any fund managers being that confident in something that they give it a 10. But for me, I thought that was very interesting. I think, outside of that, one of the things that we were looking at was bond yields and the potential for a sell-off in sovereign bonds, potential for bonds to rise. I think one of the key themes that came through to me is actually, well, it's quite difficult for central banks to raise rates in the current environment, in the sense that there is so much debt there. You know, that debt is sustainable right now because interest rates are so low, therefore interest payments are low. But it's actually quite difficult to raise interest rates in the current environment. So in some ways that adds to stability and potentially means that there's less likelihood of, I guess, a central bank policy mistake coming through. So they're just a couple of things that I found interesting. I'm not sure, Jeff or Mark, if there's anything else.
I think it's worth building on that point there, Chris, around policy, and it maybe ties a little bit back into one of the things that we didn't mention when we talked about November and the US presidential election.
Yeah.
And you know, it's amazing, isn't it, how quickly we can forget about something that was top of mind for us and for the market for a large period of this year, yet we've now moved on and it's kind of in the background. But there are very important negotiations ongoing there, and one of the things that did come out was around the trade-off between the vaccines working as stimulus but the need for potential further fiscal support to come through. And that fiscal support is not just something that we're looking, and the market is looking for to come through probably in the US, but it's also looking for something to come through from the ECB over the coming weeks as well, and maybe even the MPC, depending on where the discussions are going at the minute around Brexit. So there was that subtle theme around the fiscal side of things and what treasuries are going to do versus the role that central banks will continue to play. And I think there is probably a need for further fiscal support in the US, particularly when we think about the unemployment situation there. We'll get the non-farm payrolls today, but we've seen a bit of variability is maybe the best way to describe it in some of the employment trends there, and that's the bit that we need to get through. I think the managers themselves are positive and supportive of that recovery, but I think there's a realization that there might be a few speed bumps as we get from here to there. And again, it speaks to the proposition that we have about having those different exposures in the portfolio such that when we hit a speed bump, that it is diversifying and mitigating some of that risk for our end clients. So I think there's those factors as well that need to play into and did play into the discussions we've been having this week.
It was interesting to learn a bit more about Joe Biden's administration, Janet Yellen, looking to come into that, former governor of the Federal Reserve, so a very close relationship with, you know, the workings of the Federal Reserve should be very positive for that interaction, the communication around policy. But one of the things that was noted was the need for fiscal stimulus. You know, monetary policy is there. It has been there since March to a substantial degree, and that's done, you know, great benefit to the confidence of the market, to liquidity, into asset price performance. But yeah, that real push for fiscal stimulus is there.
I think it's George, sorry, Mark, go ahead.
I was just going to say to George, when he's talking about precious metals, I thought he was going to tell us he'd been up on the church roof again. But he's
the snow stopped us this morning, Mark.
Yeah. And the point I was going to say, Jeff, is that within the funds that make up the portfolios, there's management. So change is happening each and every day when our investment partners deem it it's necessary to move the funds forward. And I know that we've got a meeting later today, all of us, the bigger investment team, where we're going to be looking at the portfolios themselves. And at times we don't need to make any changes to the manager weightings because of what's happened during the month. And that's what I was talking to George about there, that he's been on a lot of the calls this week, and we have seen change. And it's quite interesting that over the last, 6 to 8 weeks, there has been that drift into smaller companies. And when I say drift, that's a conscious decision that the managers have taken to move away from the large cap into the smaller cap. And it's driven by the consumer. You know, in the UK this week, we've seen two of the former giants of the high street almost collapse. and for certain will collapse in Debenhams and Arcadia Group. I know Lady Green's put 50 million quid into the Arcadia pension fund, but it's not going to help those stores recover. And when you're reading the downfall of Arcadia in particular, many reporters are citing the lack of an online presence and how slow they were to recognise that. And I think that a lot of businesses will not come through this. It's going to be an accelerator. And we've covered this on many occasions on the podcast to say that the True Potential model is set up to work remotely, to work online. We function as an investment management team, and as I mentioned earlier, we've had our best ever month for inflows, new money coming in, and we've got those portfolio performance figures by working online effectively as a team, and clients have got access to all of the information they need to look up in their portfolios. For me, there's still signs that the consumer is not ready to return to normal. And one of the things I noticed this week with the top Warner Brothers films, the release of the two Big Four in, I think, June, they're going to stream them on HBO Max at the same time as releasing them into a cinema. And funny enough, HBO Max is owned by AT&T, who also own Warner Brothers, which I think is causing a bit of tension within the industry as well. But Chris, I'm coming on to you to ask you a little bit about that paper you were reading about how people are going to return to the hospitality industry in London. Could you just spend a couple of minutes on that? And then, Jeff, we'll come back to what was probably a very sensible point you were going to make, and I've taken it somewhere else.
Yeah, sure. So just before we started filming today, I was talking about something that I was reading last night, which was it was basically someone who'd toured different London pubs, and what they'd done is they'd seen were they open, how busy they were, but then they'd also tried to look at what is the definition of a substantial meal, and how can that definition be stretched in some ways. So I think firstly what they said is that most of the pubs were open, which I guess you would expect. Secondly, they said that most of the pubs are actually quite busy. People haven't been able to go out for 4 weeks, whatever it is. So in some ways, you'd expect that. And it's central London as well. So you'd normally expect most places to be fairly busy anyway. But then when it came to the meals, there were lots of different things. So you obviously had the kind of standard pub meal, which is fine, is normal. But then people were doing things like bringing a Chinese takeaway in. My favorite one was someone had brought a sandwich in from Tesco's, and they kind of peeled the wrapping off it and just left it open. And then that was classed as a kind of substantial meal, which, a sandwich is a substantial meal. And then the other thing that they're saying is some of the pubs had a 3-drink maximum per meal. So what they said is the person would come in, they buy, whatever the meal is, and then they buy their 3 drinks, but still want another drink. So they then go back and buy a meal. So actually in the article, what it was saying was actually quite a lot of food waste. And in some ways it was a bit sad. It was actually quite close to a food bank. And it just said, and the guy in the pub said, I've bought an extra meal here that I don't really need, but it's because I don't want to go after, an hour and a half, something like that. So it'll be interesting to see how it plays out. But for me, just the rules just seem to be a bit silly in some ways, and they're obviously open to interpretation. So
the pubs might start doing 7-course meals. They might turn down that route.
Well, that was the other one was I was talking to one of my friends in Liverpool, and they were talking about a local pub that doesn't really do food, so it's like a very kind of traditional old style pub, and what they've done is they put on it's called scouse, which is like a lamb stew, and they give you a plate of scouse for £1, and I think it's every so many drinks you've then got to pay £1 to kind of refill your plate. But I probably wouldn't want to necessarily be eating it. It'd be fine for it to be on the table, but I don't know how nice it'd be. But that was their way of getting around the rules.
I suppose it's a bit of innovation, isn't it? People will always innovate to try, and if you put a rule in place, people will try and find a way around it. And I suppose it's innovation at the heart of that, trying to get businesses actually back to function. Because they need money, they need footfall, and it's good that they're trying, and that's what we need. But I suppose, as we were talking about earlier, as we get the vaccine rolled out, that can be even faster. And there's something else, I suppose, that we could touch on. The UK is the first country to approve the Pfizer vaccine for rollout. So hopefully that will allow parts of the economy to start to reopen and go back to some form of normal operating over the next number of months.
Jeff, yeah, absolutely right there. And there's been some sniping gone on in the last couple of days about the UK being first to approve that. We've seen that comments from the Trump administration, and then they were retracted. And then we've also had it from the EU. Somebody has to be first. Let's face it, somebody has to be. Yeah. And why not? Why not the UK if all of the checks have been done and we can get it out and into circulation? I'm going to bring George in at this point here, because I do want to talk a little bit about Brexit. June 2016 seems to be a long, long time ago, but we're still now into Brexit negotiations. Extremely sluggish was the description, and I'm not sure if that's a description of the talks or the people who are, taking part in the talks, but there's claims that new elements have been brought into negotiations at the 11th hour, etc. We've seen the takeaway meals. Didn't seem to be any drinks going in with them, Chris, on the negotiating teams during yesterday. And there's other signs that not all is well in the EU. George, what's your take on what's happening at the moment?
Well, what can you say? We've had all sorts of deadlines pushed out, and we really are at the 11th hour now. So the options are, a deal which at the moment looks as though there will be somebody thrown under the bus, or somebody hung out to dry a little bit. But it comes down to negotiation, whether it's around the what's considered fair, I suppose. But what's being priced in at this point, bit more expectation that a deal will come through. If we look at sterling, you've seen sterling up from around 128 at the beginning of October against the dollar. You had around 134 there this morning there, so a bit more optimism coming through. Under WT rules, things will be a lot tighter, but the general consensus from our managers is a bit more optimism starting to come through that a package will be derived. It's very difficult to say at this point, because I've seen already this morning 3 different headlines that we're getting closer, we're being pushed back, we're getting closer.
I think that's the thing. There's something for everyone in the headlines. You see what the Irish government minister's saying, we're getting closer. You see what Macron is saying, and in France we're getting further apart, and something for everyone. And I think we'll just all have to wait and see with sort of bated breath to what might come out ahead of this meeting on the 10th, or maybe nothing will come out for that meeting, and we'll go down another week of further discussion and debate about, when you take a step back and you look at some of the things that are causing the challenge, they're so small as a percentage of GDP for either the UK or for the European Union, and it just seems bizarre at one level that those are the issues that we've got ourselves hung up on, when there are so many bigger problems that both the UK and the EU are focusing on trying to address. And Mark, I think you very subtly mentioned the challenges that the EU continues to face. We were back in July talking about them getting through with the COVID-19 pandemic, the support package that they put in place, the 750 billion euros, and that was very, very supportive for European assets in the euro point in time. And fast forward to today, and we're still stuck in the typical EU round of discussions to get that approved, with two members, Poland and Hungary, being well, a bit obstinate in terms of approving it for probably the wrong reasons. And interesting just to note yesterday that a few of the sort of the senior negotiators are really looking at ways to get round Poland and Hungary and just get this 750 billion package rolled out, because it is needed in parts of Europe, particularly given the severity of lockdowns that we've seen in the likes of Spain, the ongoing challenges in Germany from lockdown. They're locked down until 10th of January now. So there is a need for it to come through, but the old challenges of the EU are still evident as well for us all to see.
I think that's true, Jeff. You know, when is a union not a union? Well, it seems to be at the minute with Poland and Hungary. And Johannes Hahn, who was the EU budget commissioner, you know, in an interview with the FT this morning, he said that this could backfire on the citizens. And that doesn't seem to be a very much of a unionist approach to anything, really. But yeah, we'll see what's happened. And you know, you were talking earlier about the pound versus the dollar, and I think some of the strength of the pound in there has been as a result of what people have been expecting coming out of these talks in London. So we'll keep an eye on the currency markets as well as the equity markets over the coming days.
And it probably is, as we've seen over the past number of weeks, the currency market that gives us the cleanest sort of read on what's actually happening. And if we break that down into sort of some of its component parts, we can see that, you know, over the course of the month that yes, sterling has strengthened. It's strengthened a lot against the dollar, but then I would probably contend that a good bit of that is dollar weakness. And then if we look at what's coming through in terms of the sterling euro, sort of the currency there, you've seen a little bit of appreciation of sterling, but not to the magnitude that one could see if we get ourselves into some more clarity around what an agreement or non-agreement will look like from the 1st of January next year. And you get a sense of that every day. You see that the markets reacting to just these headlines. So there is a way for us to see that, and I think it definitely manifests itself first in the currency markets. It's the quickest to react to these discussions, and we'll continue probably to seeing that play out. But the other, I suppose, going back to something that we touched on earlier, and the key themes discussion is definitely around a view of dollar weakness going forward, and that's an important thing for asset markets in general to deal with and to think about the opportunities that creates. If we look at emerging markets, another area where our managers were discussing their positive leaning towards that over the course of the past couple of days, that's an area that's a big beneficiary of dollar weakness and the implication that might have for commodities. And I just wanted to go back to something I said at the start about within markets. So we think of emerging markets in Asia as a homogenous group of countries. They're all very different. If we just look at last month, we got Brazil, the Bovespa was up 20%. If we look at China, it was up 6%. And those are the opportunities that our managers are seeking to exploit for our clients. They can be, going back to something George says, really agile about how they implement some of these things. So looking at it through what's the best and most efficient way to do it. Is it through the equity market? Is it through the bond market? Or is it through currency markets? They have got that toolkit to utilize, and they're utilizing it all the time, looking for those opportunities for the end client. So agility crucial, and something that's very important for us as an investment team to be focused on is just how that is playing out in the portfolios all the way through the month. So as George was saying, we're constantly analysing and looking at the portfolios, assessing those change relative to the core view that we have around how markets will continue to evolve. And just seeing that evolution is crucial to maybe to your point, Mark, that we don't have to make active changes within the allocation because there is at times so much going in below the bonnet, but it's crucial that as a team, we're focused on that, we understand it, and we understand the implications that brings for our end clients.
We spoke about cyclicality before, but at a high level, that could be just termed as moving from industry to industry. But even within individual industries, there are winners and losers. And if you take retail, we spoke before about both Debenhams and Arcadia, and contrast that with the queues that we're seeing outside of the new high street fashion stores such as Primark and companies like Next, who again got right on the front foot with online shopping and deliveries. Probably Next were the first ones that brought that into everybody's homes. Order by 10 o'clock and you'd have the goods delivered next day. And the logistics around that, I think, are interesting to look at. And I know we were talking to one of the managers a few months ago, and they were very keen that you could invest in that online shopping boom. But they were saying avoid the last hour of that. So they weren't keen on investing in the delivery companies. It was the technology that was driving it and the supply, but not, the person who knocks on the door. I can't count how many podcasts and web meetings that we've had interrupted by somebody saying, oh, there's a knock at the door, and then a parcel comes in. But Jeff and myself were on a call earlier this week where the gentleman who was on the other end of it was interrupted, and he came back and he apologized because it was somebody who'd come to collect his father-in-law's COVID test that was in the fridge.
It was the first time I've heard that, and I must admit I was a bit like, how do I respond to that comment?
I think we just let it go, Jeff.
Why are you opening up the door and you don't have a mask or anything? Is your father-in-law living with you here, and why has he had a COVID test? And yeah, it was a bit of a strange one, right enough. From that.
You've reminded me of something. The local park that we live by. We used to go for walks there in the summer a lot. And what they started to do in summer was to set up different food trucks. So you walk past them, and it felt like a different food truck would turn up each day. And anyway, there's one truck which seemed to be kind of quite far away from the others, and there was a massive queue for it. And I said to Maura, my girlfriend, I was like, I wonder what that is. We should go over. There's a really big queue. It must be something really good. But it was a COVID testing station.
You wouldn't want anything from there, Chris.
No. Yeah.
Perhaps a bottle of Corona, George.
Yeah.
I know on last week's podcast, Daniel was talking about the charity activities that we've got going at True Potential, including the banning of the C word, where if that festive word is said, that the offender has to put money in a pot. But I think we could have doubled or increased the pot by even bigger if we included the phrase "you're on mute" in there. The number of times that's happened as well.
We've started bringing that afternoon session, our afternoon team meeting. So we've increased the pot there, Mark.
And well done, George.
The pot is kind of growing quite exponentially as well. There's some of us, and I include myself in that, has not been very good at this game, so it is costing me a little bit of money, but all for a very good cause. So there are some of my colleagues that are very good at tripping you into using that word, which is an interesting concept for me to get my head around, because I keep stepping and stumbling into the trap.
There's one in particular who's had a number of years of experience of tripping people up on this, and he's very expensive to speak to, so try and avoid at all costs.
But Jeff, we've touched on something that how the investment team at True Potential have changed the way that we have our day-to-day meetings. Everybody gets together in the morning, you discuss what's happened overnight, what happened the previous day, and then meet again at 4:30 in the afternoon. And it's all done via Zoom meeting or Teams, as we're using at the moment. Have you felt a benefit of that, Jeff? Or has there been an element of remoteness that you had to overcome, at least in the first few weeks?
Well, I think as the first few weeks, we're sort of finding our feet and thinking, well, what is the right format to have for our meetings, and how are we going to do this? But as it's evolved, it's kind of become, I suppose, quite second nature to us all. It becomes the way of doing things. We've evolved our processes to accommodate it. I think the one challenge that it still presents for not just us but for everyone is just how you have those off the cuff conversations. The ones where you're just you're speaking to somebody, or you hear somebody saying something, you think, oh, that's interesting, I wonder why that's the case, or how do you find out a bit more about that? And that's something that we're finding ways to get around in terms of being much more using of the technology, so using the messaging function really all the time effectively to communicate with one another, just using this as our standard means of communication. So if there is a question that we want to ask, well, just hit the red button or the blue button as the case may be, and give somebody a buzz and ask the question. So it probably forces you to be more organized in your communications, if that's the right way to describe it. But that organization takes a little bit of the spontaneity away as well, that you just get from being together as a group of individuals. So I think going back to your point earlier about evolving and sort of thinking about how businesses have evolved, what it has really shown is that as a business, technology is at the heart of it, and it's all about the people and the interaction with that technology.
Jeff, just I guess one thing for me, which is just actually how we've been communicating with the managers. And in some ways, what I think is good about this is it's not necessarily just because of the pandemic. It's actually something that we've been doing for a while, and that's because a lot of our managers aren't based in the UK. You know, for example, SEI, one of the people that we speak to is based out in New Jersey, and that's great because it means you get a US perspective on not just investment, but on the pandemic as well. You can ask them, what restrictions are they under right now, what's happening where they live, and it's not just SEI. There are other managers as well. So for me, I think technology has been really, really important during the pandemic. It's been absolutely essential. But actually, it allows you to do business better. It allows you to get better investment information through using video calls. And I think, as well as that, I think the other thing is video calls are really good in the sense you can see the person's face. If you're on a normal standard call, you don't really know their reaction when you ask them a question. And for me, it's quite a powerful thing to be able to see their facial movements, how they're looking, what they're thinking, because actually a lot of kind of body movement gives you an idea overall of what they're thinking. But I guess maybe one other thing, and Jeff, I don't know if you want to touch on this, but we had the investment committee, it was probably about 2 or 3 weeks ago, and that was remote as well, and I thought that went very well. I don't know if you want to build on that, Jeff?
Yeah, I suppose it really builds on how we've, as a business, have adapted to use technology. And so exactly as we would have done if we'd been all in the office, we've continued to have that oversight committee. So the independent investment committee has continued to function and operate, meeting with the managers and providing back the feedback to ourselves, again, on this type of format. So as a business, it's just been a way of working that we've adapted to, and it's become second nature, a bit like, I suppose, that technology is at the core and at the heart of everything that True Potential does. So we've just continued to build on that, and we've been utilizing technology to the best of its capabilities, really, and pushing the boundaries of that so that we can continue to do what we need to do to run the money for our end clients and deliver the returns that they need. And just to build it. Sorry, go ahead.
You finished, Jeff. Apologies.
I was just going to say that at the moment we've got 2 of our colleagues that are using this technology to speak to a Chinese equity manager based in Hong Kong, and that's the sort of insight that we can get for our clients, and we can use that within the portfolios. And again, it's using mediums like this, to your very point, Chris, that you can see the individual, you can get them to have the presentation and the screen, they can talk us through it, and we can interact with both the presentation and the individual, the exact same as we would do as if we were in a room in Newcastle.
And as a business, Jeff, you and I are involved in management team meetings and group board meetings next week, where we had hoped that we would be able to meet together as a group. we had plans, we had everything booked and arranged, and then we got the announcement that we were going to be in tier 3. So we had to rapidly change that, and we will have a full and effective team meeting over 2 days of next week using the technology that we have for this morning. And the business has to go on. That's the thing. And I can't help thinking, if we didn't have politicians doing the Brexit negotiations and we had business leaders, we would have had an agreement in place now, and that agreement would have been actually in force, and trade would be happening at whatever had been agreed, because that's essential for both the UK and Europe and us on a worldwide basis. And we've got a couple of trade agreements in place. Let's get some more. Hopefully we'll get something from the US once Joe Biden and his team get in place. But I think that at the risk of us having to have takeaway food delivered into our homes now, as we talk into the morning in EU negotiation style, I just want to close with a couple of points. What is it that we're looking forward to? What are the managers telling us that we should be looking forward to in the coming weeks and months?
It's an interesting starting point, I think, to roll into 2021. You've got a bit of a lopsided economy. We touched on the sector divergence, which you've had different regions, different sectors coming out of the pandemic at different levels. And that in itself creates an opportunity, especially if you're an active manager, seeing regular flows you can allocate towards that, which we've seen with our managers. You've got bonds at historically low levels, so managers have to work a little bit harder in the fixed income markets or look outside the traditional fixed income asset classes, which again, managers have been doing some examples of that. And looking at those yield levels, accounting for inflation in most developed nations, you've got negative real yield levels as well. So and probably stay that way through much of 2021. The expectation is for interest rates to remain low, and for inflation to sort of not reach target quite yet, but is ticking up. I think what can we expect to see come through? Well, looking at the revision from the OECD, a more optimistic outlook on economic growth, which is coming through globally in the US, especially you've seen that acceleration come through. And the new president and vice president in the White House, with some very established members in their administration, an outcome on Brexit and the vaccine. So by no means plain sailing, but there'll be a lot of opportunity out there, Mark. And I think navigation through this will be key. And that's, back to our earlier point, that's the reason we take a diversified approach and partner with the partners we do.
And I suppose those partners are some of the best and most agile asset managers across the globe, and they will be able to navigate that and seek out those opportunities. And if I think about it at a higher level, one of the things that I suppose think that fits with the broader discussion that we've been having today is just innovation, and thinking about how those managers are thinking about evolving their strategies over the course of the next 12 to 18 months, addressing some of the points that George has alluded to there, of those areas where there is opportunity, but how do they exploit it to the best of their ability for our clients, and thinking about how they will evolve their portfolios over time, because at the heart of it, they are wanting to look forward and think about, in a forward sense, where they can get the best opportunity, because markets are discounting mechanisms, they're discounting the future, and they need to see where those opportunities are. And that innovation is something that we're constantly discussing with the managers as to how they're addressing certain areas, as George has mentioned, particularly around alternatives, around sovereign bonds, and where yield levels are there. So that, for me, a high level, is something that I'm looking to hear a lot more from the managers over the next 6 months in particular.
I think for me, if you think about, in some ways we've got more certainty. The reality is that we've been through the US election. We will have been through Brexit and the transition period. We have a vaccine. We've got more than one vaccine already. And I think, from listening to the managers, from my own thoughts as well, I think there's a lot of excitement about the next 12 months. And that excitement comes from a word that both Jeff and George use, which is opportunity. You know, what you're seeing is a lot of opportunity. It was interesting, one of the managers that I spoke to yesterday, he said basically he's got too many good ideas and not enough capital, which is in some ways is a fantastic place to be, because they've got so many opportunities. They're having to pick in out of those opportunities, rather than, you know, having a different environment where you're actually struggling to work out where to invest. So I think, you know, you've seen a rotation. That rotation is bringing through a lot of opportunity overall. So for me, you know, I'm looking forward to next year.
Yeah, I'd agree, Chris. I think it's time for optimism. It's time to be bold. You know, I mentioned the Ryanair order of aircraft there. You know, there's a business looking forward, clearly, and no doubt taking the opportunity to drive the price down of those Boeing aircraft. So there's somebody who has taken advantage of an opportunity in the market, and good luck to him as well. I think now it's time to bring podcast 46 to a close. Gentlemen, thank you. I know that we'll all speak together later in the day, but for everybody watching this, thank you for your time. If you like it, you know what to do. Give us a like. Please subscribe to True Potential on social media, and join us next week for podcast 47. Thank you, everyone.
Thank you.
Have a good weekend.
Thank you.
Thanks.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.